Welcome into my Vanguard portfolio update now for the month of September. We've missed a month and as a huge amount has gone on in the stock market during that time. Now, we'll do the usual stock market updates before we jump into my portfolio update. Everything will be timestamped below if you do want to jump around, but we've got a lot of interesting stuff to get into. Now, funny enough, the last video I did covering the stock market crash was just a very quick reaction video. And what's happened since has been quite interesting. So let me just have a look now at the global market. Specifically, let's have a look over at the S&P 500. Now, as you can have a look on screen now, the S&P 500 looks to have a very strong month. That's up by over 5% for the month, at least as of the time I'm recording this video. However, that doesn't really tell the whole story, because if you zoom out a bit, you will see that that really is just a recovery from that huge kind of global sell-off we had around that 5th of August timeframe. Now, if you remember the kind of reasons that kind of market crash was cited, there were several different ones going on at once, and lots of people can create their own narratives around that. So one of the first ones was concerns around US job data, and were kind of leading people to think that there was going to be a recession ahead. So that was one of the main reasons for the sell-off. But then also another thing that was cited and covered quite widely here on YouTube and financial media was this yen carry trade, effectively traders borrowing cheap money over in Japan, for example, and throwing that into the US market. And now as the US market declined, people were leveraged, had to force sell, etc. Also general fears around algorithmic trading, which just, of course, sees the sale in the stock market and just keeps selling and stuff. So you never really know who's behind that, but stocks had a huge fall and it was reflected globally in every single index that you can follow. Now, interestingly enough, I wanted to look into this one because I saw a couple of different reactions to this. And what I mean by that is that I was wondering who was selling here and who were the net buyers of this dip. Now, initially, I saw an article which suggested that retail investors like you and me were people who jumped in there, saw those prices and thought, you know what, stocks are cheap now, so I'm going to go in and get some extra money in there. No doubt some of you did, so do let me know in the comments section. Now, this article here suggests that Robinhood, the broker in the US, big popular broker in the US, they do have a UK app now. They received $1 billion of new cash from retail investor clients in that first week of August. And they even said that $500 million was deposited to client accounts during Monday's sell-off. However, just looking into the article, it did say that retail interest in the 20-year Treasury bond ETF soared during the recovery. So now that says to me that people are less interested in buying the exciting stocks like Nvidia and Tesla and everything else that apparently is going to the moon. And they've actually gone to much safer styles of assets. Now, the 20-year Treasury bond is an extremely long duration bond. It's quite interesting to see retail investors choosing that one. Really, people doing that must be expecting some difficult times ahead. Now, another article I saw, which was probably a lot more bearish from the retail investor side, was this one here. And this data looks to have come from JP Morgan, effectively saying that, and I'll quote you here, the retail order imbalance ended the day at minus $1 billion, which is 2.5 standard deviations below the 12-month average. So basically, people were selling a lot more than normal. Interestingly here, they said inflows into ETF were $472 million, but they were outweighed by outflows from individual stocks at minus $1.4 billion. So basically, as I kind of hinted at earlier, lots of people moved away from individual names, individual stocks, and went into ETFs like the S&P 500, etc. So people kind of thinking, right, maybe these gains, this AI bubble, this gold rush, maybe I'll kind of finally diversify my portfolio, which I found pretty interesting that lots of people did that. Now, one thing I wanted to just highlight there, and this comes back to a point I talk about so much on this channel, many of you will be familiar with this, and I will forever bang this drum, but let me just mention this and quote you now. So this quote in this article, we estimate retail investor performance has declined by 10% since the peak in US equities as of today, versus 8.5% drop in the S&P 500. Year to date, their portfolio, so retail investors' portfolio, is down minus 4.9%. So I don't know exactly what kind of data set they're using. I presume they're just using all of their retail investor data set here, but effectively they're saying that as of 2024 year-to-date performance, retail investors, at least those who are investing with JP Morgan, are in the negative, which to me is bonkers. Anyone who is in the red in 2024 is clearly doing something very, very wrong. And it does come back to something I preach a lot on this channel, and that is a few core basic investing principles. A, not trying to time the market and avoiding doing anything during periods like this. And secondly, making sure you use things like low-cost index funds as that core of your portfolio, and dollar cost averaging in basically no matter what happens, because then you can avoid all of this nonsense. Because quite frankly, if you are in the negative in 2024 with the year the market's had so far, it's not been massively exceptional, but you really shouldn't be down in a year like this one. And it's a shame that potentially thousands, maybe even hundreds of thousands, or maybe even millions of investors are down in this one. So it's a drum I won't stop banging, and many people will probably be quite sick of it and bored, but just go back to those long-term kind of fun, long-term foundational things when it comes to investing. And yes, they are boring, and yes, they're not exciting, but you do have to remember them. And another thing I'll say here is that everyone claims to be a long-term investor with diamond hands, basically until they're not, which is days like this when they see the market going crazy. And because the market had declined massively in that pre-market on the August the 5th, that all that trading took place in the morning, people looking at their portfolio, looking at their phones, thinking, right, I better sell, which really is mind-boggling to me. So please don't fall for the same traps. Now, moving on from the crash, as I published that video, I was still waiting for Nvidia's latest quarterly earnings report. At the moment, it feels like Nvidia is carrying the full weight of the stock market. I imagine that meme of that big giant, that boulder, and Nvidia at the moment is the kind of the darling of the stock market. Now, their earnings came out, and by all means, they were good, beat expectations on all fronts. Stock didn't do a massive amount during that kind of first initial move, and it was almost like it was good, but maybe not good enough, so potential slowdowns were in order. However, since then, you can see what the stock has done. Let me just bring up Nvidia's price chart here. So for the month, it certainly looked amazing, shooting up 30% since the lows, but I then kind of pulled back quite a lot, and now it's sat around $107, just slightly up for the month. Another thing you will see is just at least over the past couple of days, the Nvidia made the headlines yet again, being down 10% in just a single day. Now, one thing I want to highlight here, and this will make the news because as the market cap of the likes of Nvidia gets so big, 10% of the company is hundreds of billions of dollars. So this makes very, very scary headlines at the moment. And another thing I wanted to highlight was that Nvidia is turning into a bit of it's very much been led by the traders out there as well. So let me just show you, at least from yesterday, as I'm recording this video, some of the most traded stocks in the stock market. And you won't be any surprise here to see Nvidia here at the top, but also another popular name, Tesla, being one of the second biggest. Even though it's not anywhere near the biggest company in the market, it still becomes one of the top traded. And look at the rest of the names in this list. You know, you have still some relatively big names, but they don't trade anywhere near as much as these. So there's just so much activity going on. No doubt a huge amount of this is driven in the options market rather than just retail investors, but very interesting to look at. And it kind of does conflict with lots of people saying, well, they're long-term investors, they're going to hold forever, but there's a huge amount of opportunity out there. Not opportunity, I should say, but there's a huge amount of people out there who are just short-term traders. So use your long-term to your advantage if you really are interested in this kind of investment and stock. Now, I would certainly say at the moment, kind of US stocks and generally the global stock market feels very jittery in that any kind of new economic data that comes out, good or bad, traders are there ready to react to it with big swings rather than just kind of a flat line. And let's just have a look at some of the data which has been coming out of the US over the past few weeks. And we've still got some interesting data ahead. So as you can see, first off this week, we had the US PMI data, which surveys the manufacturing industry. Let me just quote you now from some of the findings there. The ISM said its manufacturing PMI rose to 47.2 last month from 46.8 in July, which was the lowest reading since November. Now, a PMI reading below 50 indicates a contraction in the manufacturing sector, which accounts for 10.3% of the economy. So slight slowdown in that sector. I would say it's important to a certain extent, but it is, again, important to remember that last line there that only makes up a small part of the US economy. I wouldn't really call the US a manufacturing economy. Now, clearly there were some, reactions to this. It's not a positive thing to see. However, let me just show you another interesting report that came out. So we have the Fed's Beige book, something that I haven't really covered before on this channel. That comes out 8 times a year. Basically, they survey all of the regional Federal Reserve banks, and they'll report back on everything going on in their area, whether that's wage growth, jobs, the economy, sales, etc. And let me just show you what they found. And I'll just quickly grab the report itself and put it up on screen now for you to have a look at. If you are really bored, you can go through the whole thing and have a little read. Economic activity grew slightly in 3 districts, while the number of districts that reported flat or declining activity rose from 5 in the prior period to 9 in the current period. Employment levels were steady overall, though there were isolated reports that firms filed only necessary positions, reduced hours and shifts, or lowered overall employment levels through attrition. Still, reports of layoffs remained rare. On balance, wage growth was modest, while increases in non-labour input costs and selling prices ranged from slight to moderate. Consumer spending ticked down in most districts, having generally held steady during the prior reporting period. So some kind of, I'd say, neutral, maybe slightly bearish language there. Not kind of a recessionary fear, certainly, but not amazingly strong and amazingly positive. And that would then lead me on to the final topic that I want to talk about in the US markets, and that is interest rate. Because if anything, news like this just puts much more pressure on the Federal Reserve to start cutting interest rates over in the US. Now, you may have seen Jerome Powell do his usual speech over in Jackson Hole, which just looks like a lovely place I'd like to visit. Quite nice if you're going to go fishing and have a look at the mountains. Definitely sounded quite dovish in that meeting, meaning that really rates are set to become lower and set to get lower maybe faster and more aggressively than most people first expected, but only really time can tell. First rate cuts are certainly already baked in by the markets, and expectations are that there's going to be several rate cuts as we end out the year. No doubt a lot of this also will hang on that jobs data, which is more to come, and by the time I've published this video, you'll probably see that latest report, unless I've edited it and you can see it now on screen, but I'll probably won't get around to be able to do that. So you can pay attention to that. Remember that the Federal Reserve over in the US has that dual mandate, and not only to keep inflation under control, but they also want to keep employment strong at the same time. So you're always between the rock and the hard place of making sure that you don't raise rates so high that, okay, maybe you keep inflation under control, but then if everyone goes unemployed because businesses don't want to invest anymore, then that puts them in a very bad position. So we are expecting that first quarter point rate cut from the Federal Reserve over in the US, and maybe many more to come. There is small expectations that they might cut it slightly more, but as always, it's a very difficult balancing act, and anyone that says otherwise, I think, is just kidding themselves. You're very welcome to be an armchair critic, and you're welcome to go and take the job if you want, but I wouldn't want that job. Now, UK markets and the rest of the world, let's have a quick look here, at least from a UK perspective. Let's have a look at the FTSE All-Share, which is a good index covering the entire UK. Last month, up just over 2%. Also, the graph kind of looks like it's had a great month, but really, it's all been from that recovery on the 5th of August. The FTSE 100 almost in identical shape. It's just a couple of points now away from those all-time highs that we set back in May time. How long it takes to get back up to them, I have no idea. European stocks also don't spend a huge amount of time, but they had a similar ride. I'll just take the Euro Stocks index here. Although they've had a larger recovery, so that 1 month graph looks amazing, they've not really had a particularly good year to date, at least when you compare to the likes of the S&P 500 over in the US. Now, just touching on UK interest rates, remember the Bank of England reduced rates from 5.25% to 5%, which was the first drop we've seen since the pandemic of March 2020. Expectations for the future, at least from Capital Economics, as you can see on screen now, they expect rates to come down to around 3% by 2025 and beyond, but other expectations suggest something around 3.5%, which is where they'll remain. Whether those predictions come true or not, I have no idea. Pretty much, unless there's going to be another crisis, I think we can expect interest rates to remain kind of higher for longer. And you have to remember that rates like this, they aren't historically, on an average basis, really that high. The period we saw post global financial crisis and post the pandemic were really unprecedented. No time through history have rates been so low, forcing all asset prices up because there was really nothing better to do with your money. There will be a lot of pressure on the UK Bank of England to make sure they keep reducing those interest rates in the face of the difficult fiscal situation we find ourselves here in the UK. It not only affects public spending and borrowing, but of course for the likes of yourselves and your mortgages, which potentially going to have to be remortgaged over in the next 18 months. Last data I looked at that, there's millions of people who are going to be affected by high rates if rates don't come down. So anyone remortgaging now, unfortunately, is going to lock themselves into significantly higher rates than before. Now, UK inflation, which interest rates are directly tied into, I just wanted to touch on that one. You may have seen the latest inflation data come through from the UK. Headlines all were pretty much congratulatory. Everyone's saying inflation is down to 2.2%, at least on the CPI reading. But CPIH, which includes housing, which is one of the most important costs, is up at 3.1%. Now, if they can keep that there and not keep inflation too sticky, then they can bring interest rates down. But again, the difficulty, as I said before, is they're always between a rock and a hard place of what to do. The worst thing you want is inflation being out of control. For example, services, wage growth certainly, potentially staying out of control. We just don't know what's going to happen there. So it's a really difficult balance to strike, but there is expectations that rates will come down and settle around that kind of 3.5% area. Now, final point I wanted to mention, I didn't think I'd be talking astrology in this video, but there is a giant fiscal black hole in the UK economy, at least according to the UK government at the moment. And there will be a new budget coming up in the autumn, and there will be some big changes to taxation. I definitely want to cover those on this channel. I don't want to speculate too much. I think yes, you can make a clickbaity video, which lots of people have done, on all the tax changes and everyone's coming for your money, but I'm really not into that kind of clickbait style waste of time video. Now, what I did want to highlight though is I will cover any tax changes which at least affect investors. So I'll be looking at things like capital gains, dividends taxes, anything around pensions and ISAs potentially. The difficulty the government have put themselves into now is say that they won't cut or have any impact on national insurance, income tax and VAT, which, as most of you will know, makes up the majority of the UK tax intake. So that does leave them with things like capital gains tax, inheritance tax, tax relief on pensions, etc. So I will cover that and kind of simplify that when that comes out. It will be definitely an interesting time to see how they find these tens of billions that are needed in savings. So personally, I don't see them doing any major cuts in terms of saying like, you know, your ISA allowance is going to get cut, or maybe pensions, the amount you can put into your pension get cut, but certainly some of the tax reliefs, at least on the pension side, probably more likely. But again, we'll wait and see. Rather than just speculating, I'd rather just see what happens. Right, anyway, time to jump straight into the portfolio now to have a look at. As many regular viewers will know, this is where I keep my self-invested personal pension. So I did used to have an ISA as well with Vanguard, but now I just keep it nice and simple where I just use this for my pension. There is still a small amount left in my ISA before I transferred it. I did message Vanguard and I did say, can you just transfer the rest, which was like interest income? I think they said yes, but I'm going to have to maybe chase them up on that one because it just looks messy in the account, so I don't really want that. Now, I do contribute to this now through my business. So before I kind of left it, before this was a collection of my old investments, my old pensions from different workplaces. Really simple to do that, by the way. I know I always get lots of comments on how to do that. I went through basically my old workplaces, make sure I checked where the pensions were, went onto the Vanguard platform, followed out the transfer form, just a few details you need, like the account numbers and the old places. And all those old pensions were moved into this one a couple of years ago now, which is quite nice. It means I can invest it in whatever I want myself, keep my fees a lot lower, and really I just like having it all, knowing that it's all there and invested for me. And now what's good about the self-invested personal pension, and especially on the Vanguard platform, and not every platform, by the way, allows you to do this, but I can make contributions not only from my limited company, but I can make contributions for myself personally. And those will have different tax relief and tax benefits, but I can do this both in a single account, which is quite nice. Now, if I just have a look here, you can see kind of total gain and loss through every investment that I've made. And what's quite nice is where you can see the contributions this tax year of where I've made my contributions to the pension itself. At the moment, I'm putting in £500 a month from my company. I may change that and try and max that out as much as I can. Balancing really your ISAs and SIPs and your ISAs and pensions. Remember, they're kind of your two rock stars, if you like, the two most powerful types of investing account that you can use. By the way, if you want to get yourself started with any accounts, or especially ISAs, for example, or get yourself invested with your business cash, which is another video I need to do, I do leave all the links in the description below if you want to get yourself started and get yourself some free cash or free shares. Also, another thing I am going to build out, as I said in the last video I did as a channel update, if you do want to get part and be part of the community which I'm trying to set up, make sure you drop your email down below. If you follow the link in the description, it'll be the top link, and that'll take you through to make sure you're on my email list. There are thousands of people on that one now, and what I hope to do is create a community at some point, which I hope we can grow, even if a fraction of the people ended up joining that one, where we can create like-minded people, where we can talk about finance, investing, all these kind of things, pensions, and maybe even we'll do some gaming as well, because I'm a bit of a gaming nerd, so we can play that. But make sure you get yourself below and check that out as well. So let's just have a look at performance, and just a reminder for regular viewers will know how I like to keep things so simple in my pension, and simplicity is just so good because honestly, I never check this. And it's such a nice thing to know that I don't waste my time logging on every day, seeing how my investments have performed. I keep things super simple, one single fund. I use the FTSE the FTSE Global All Cap Index Fund accumulation version. So this is a global index fund, mutual fund, where money is pulled together and invested in companies all around the world. There are thousands of companies in this one. It's a simple market cap weighted index fund, completely passive. The larger the companies are, the more of the money that fund will take in. Relatively low cost as well. Yes, there's cheaper ones out there, certainly. You could just go S&P 500 or a developed world fund, but this is one of the ones I like to choose. And it's just so nice knowing that it's a single fund, everything's balanced. I just leave the market to things, and then I can just regularly invest money in this one month after month. Let's have a look at performance, because the market at one point was just going up and up and up and up and up. And I remember every single portfolio update was just like, new all-time highs. As we can see here, if I go actually looking at monthly performance, you can see September has been pretty poor so far. So it's taken a big chunk out of our cumulative returns. But as I say many times, doesn't bother me in the slightest. These red numbers here, and when we went through that bad period, especially if we go back to like 2022, for example, didn't bother me at all. June 2022, cumulative returns down negative 3,000. December 2022, negative 2,000. Just didn't bother me in the slightest, to be honest. If anything, I've said this multiple times before, I've got my mentality round now. When I see dips in global stock market, it's just my strategy remains exactly the same. I don't have money sat on the side waiting to invest. I just do the same thing month in, month out. And most people will be far better off doing something like that than just trying to time the market. But you're very welcome to do whatever you want, but you will probably end up like some of the people we first spoke about in the first part of the video when we looked at how retail investors, most of them do. Unfortunately, most people will continue to underperform the returns even of a basic index fund. And I think that's probably going to continue, probably forever, but you can kind of escape that if you want and just keep things super simple. So there's how things are looking at the moment. I'm going to continue to invest on this one regularly. And if I can plow a bit more money into it, I certainly would. If rules change on ISAs and SIPs in the next few months with the budget, would I review that? Potentially, yes, because pensions are a big area that the government might want to have a little bit of a tax grab at. But I don't worry too much about that, because at the end of the day, if these things do get changed, then there's not much else I can really do. I'm just going to make sure, and I'm sure you will as well, really, when it comes to investing, just make the most of whatever you can, whether it is ISAs or whether it is pensions, whether one becomes more powerful than the other. Just use whatever you can at the time. There's no point trying to predict the future, or let's say if, ISA allowances got reduced and taxes on pensions got changed in some way. At the end of the day, that's still better than a general investing account. So still going to do the same thing. So you can complain all you want, but it shouldn't really affect your behavior. And I think that if that is a lesson of this month's portfolio update, I hope that's the thing. All of the crazy things going on in the stock market, could there be a recession ahead? Could there be a crash ahead? There always could be. And if you live your life like that, you would never invest at all. But if you watch these videos, and I hope most of you out there just do the same thing, invest regularly in the same way, month after month after month. And you should, there are no guarantees, but you should do pretty good. Anyway, I hope you've enjoyed that. Again, as I said before, make sure you're in the kind of list to be added into the community, or at least have the opportunity to get into the community later on. Links are below as always. And while you're down there, hit the like button, subscribe, and I'll see you in the next video. Happy investing.